on the commercial world, we don't look at debt to income at all. We're looking at global debt service coverage. So that's how many times your income can service your debt. Character means a lot when it comes to the commercial lending. We'd probably look at what you have in it. But then again, every deal is different. If you've owned it for a while, we'd look at it totally differently. Yeah. If you're buying the land and building, all at once, we would probably do something along the lines of, and then we would fund the entire construction.
Jack Hutcheson, thanks for being here.
Yeah, thanks for having me, man. I was excited when you gave me that call.
Yeah, so you and I, we go way back. So I've known you for a long, long time, back like probably middle school days.
Yes.
Maybe your middle school days. I think you're a couple years younger than me, but grew up in church together. So know each other as friends first, and as a client and as a lender, you funded some of my stuff. So tell the people, for those who don't know who you are, who are you, what do you do, and
Yeah, my name is Jack Hutcheson. I work for Riverbank and Trust. I've been with Riverbank for about 18 months now. I work as a relationship manager, so that pretty much means that we do everything from checking accounts all the way up to big commercial loans. So anywhere in between, that's what we kind of handle as the relationship manager side of things. Yeah, I've loved it, man. Banking's been awesome to me. I've really enjoyed it. I guess kind of take a step back. I started as an underwriter. And kind of learned the ropes through that, and then recently, about 18 months ago, moved to a lender. So it's been a fun progression, and man, we have a lot of fun doing what we do.
What's that change look like from underwriter? Is underwriter more of like W-2 9 to 5, and lenders more like, hey, I kind of make it up as I go, and different pay structure, or what is that?
Yeah, so as an underwriter, it's more of that 9 to 5 type deal. I mean, you're really helping lenders out, understanding the finances behind a deal. And so your spread numbers, you're looking to make sure that the risk is worth the loan is worth the risk for the bank. So you're behind a desk a lot, on Excel a lot, digging through financials. And then moving to a lender, it's more, you go find deals, go meet clients, go a lot of lunches, hopefully a lot of golf.
Yeah.
And so it's a lot more of a relationship type deal instead of behind a desk all day. And the pay structure is not a whole lot different. I mean, it's, as an underwriter, at least my experience, it's W-2. And then, as a lender, there's W-2 with some commission on the deals you close. So
I guess every bank kind of structured it differently, but in the residential world, it's, I think lenders are more structured. I could be wrong on this, you may know, but more structured, more like me, where it's just kind of, you're mostly commission and sink or swim kind of thing.
Right. Yeah. So the residential lenders are the mortgage lenders, really. They're eat what you kill.
Yeah.
And so, in the good years, it's awesome. And then in the lean years, it can get a little scary.
Yeah.
And so the commercial lending world is a little bit different. We got a, base pay and then whatever we close, we have goals and then you paid out on those goals.
Yeah. Awesome. And I think we worked together. The first one y'all did was when you were at the bank you were at before Riverbank.
Yeah. And so, man, I guess to take a step back, I started my bank career at Bryant Bank. Was with Brian Etheridge, and then Brian Etheridge got the market president job at Riverbank and took me with him. So
that's awesome.
It's been a nice change. Bryant Bank was awesome to me. Learned a lot of stuff, but this has been a great move for me.
Yeah, that's cool. Going from an underwriter into a lender, so like you literally learn from the ground up, like the back office stuff,
right.
What goes into a loan. So now when you're on the front side kind of selling it or talking about it, you've done it.
Yeah, and so it's kind of neat. And Brian Etheridge is the one that had the forethought to put me as an underwriter first, just so I can understand the numbers and kind of the risk tolerant of the bank. Because if you're just going out there slinging loans, you may not know, well, this is not really what we're wanting to do. Or, you can kind of from the initial conversations tell kind of how the deal is going to look. And so having that background and understanding the number side of things has really helped me as a lender.
Nice. So let's talk about loans. So all the fun stuff,
yeah.
Right? So commercial loans are very different from a residential loan, but let's talk about the different classifications and why. How much does it weigh on comps and the borrower versus the property itself? Because it's a completely different world than residential, right?
Yep. So the residential mortgage lending world, the big number you look at is debt to income. And that's kind of a buzzword in that world. And we don't really, on the commercial world, we don't look at debt to income at all. we're looking at global debt service coverage. So that's how many times your income can service your debt. So, if you're making $100,000 a year and your debts are 50,000, then your global will be 2. And so that's the big number we look at from a commercial world. I guess another big difference is on the residential or mortgage lending world, you're looking at gross income, and we look at things from a net. And so it's just a different world. It's the commercial is more of a Wild West type deal in a sense of, there's more that goes into it than just the numbers. And so, you kind of paint a story of how the deal looks, and relationships mean a lot. There's a lot more that goes into it than just your debt to income from the commercial world.
That's one of the big things I've seen and stuff that we've worked together on and quoted is there is a big separation. There's more than just do you check the boxes financially. Like in a residential mortgage, you can go to 10 different lenders and get mostly the same product because your financials don't really change.
Right.
But relationships in the commercial world, you may get a deal from one bank or from you, and I go to someone else that I don't really know, where it's just kind of a cold intro, and they don't even touch what you could do.
Yeah.
Right. Why? Tell me about that.
Yeah. So that kind of goes back to what you opened the podcast with, is the relationship. I mean, I've known you for a very long time, and character means a lot when it comes to commercial lending. And so I know your character, and I know that, when you get into a deal, you're a good person that's looking to pay the bank back, instead of somebody that I don't know that's looking to hop into something that, we may not be as comfortable with as it goes to collateral or the finances behind it. But being able to know the person, have the relationship with them, and kind of know who they are is a big help when it comes to underwriting and explaining loans to our approvers.
Yeah, that's interesting. So if you look at, and is that more so with a smaller bank? Because if you were in the commercial lending space with Wells Fargo, is it more of just a checkbox, or do those relationships play into it as much as it does with kind of a smaller bank?
Yeah, so at a community bank, we're huge on relationships, and I've never worked at a bigger bank, so I'm not exactly sure how they look at things. But from what I've heard, is there's less of a relationship, because with the bigger banks, the lenders are kind of a revolving door, so they may hop around to different banks. And so it's hard to build a relationship with a bank when, you're working with 3 or 4 different people. And so from our standpoint, just getting to know somebody is huge. And community banking is kind of that relationship, family type feel.
Yeah. That's one thing I always tell investors when they get started in the very beginning. Yes, shop it to make sure that, you're getting a good deal. But at the same time, find somebody who's great and who will fight in your corner on the lending side, and just be with them, right? And maybe 1 or 2 people, and just, use them, because at the end of the day, long term, it's going to benefit. You'll be able to get deals done that you couldn't otherwise.
Right.
Instead of just, I look at insurance somewhat the same way, always, kind of shopping that. But when you need it, you need it, right? Kind of same thing with lending. If I've got a deal that, is long term is like really sexy, but short term, hey, we got to work through some stuff. Having a relationship with a bank, knowing how I operate or how we run our business, willing to take that risk, essentially, right? Is the risk on my deal to get to that big payoff on the back end is, if I don't have a relationship, then they may not take that risk to get there.
Right, totally. And another thing that helps when you work with the same lender multiple times is we've already got everything we need from you. Yeah. So when you call me and say, hey, look, I got a house under contract, we need to close in, 15 days, if you go to a different bank, they've got to fully underwrite you. It may be, hey, that's too soon. But for somebody who already has done your finances and has everything on file, say, hey, as long as the appraisal comes back in time, let's go. And I know that we've had some stuff like that happen before where something for you came up quick and you needed to get closed.
Yeah.
I had already everything on file, and we were able to make something happen quick just because of that relationship we have and have everything already on file and ready to roll.
That's a great point. That's been a huge advantage. If I call you up and say, I need a pre-approval in an hour for $1 million for this deal, and I know it pencils, you can shoot me that in a minute, right? And just knowing, like, hey, we still got to do some due diligence on the property to make sure it's good, but, like, I know you're good for it. Right. I've already got all your information.
Right, exactly.
So, that's huge. That plays a lot into it. Very cool. Let's talk about specific loan types. So, I know commercial is very different in the sense from residential, so you don't have like a 30-year conventional,
Right.
FHA, VA, but I see a lot of ARMs right now, adjustable rate mortgages. So walk me through what that looks like. What are the terms? What are general terms that you're seeing right now?
Yeah, so on just a typical investment deal, whether it be multifamily, commercial space or just a single family investment property, we normally look at something like a 5-year note on a 20-year amortization. And so that would look like, whether you fix or float for 5 years, and then you amortize it over 20. We're going to be somewhere around prime right now. And prime is at 8.5. So that's just kind of where rates are. And it all kind of depends on the deal. There's some deals that, if it's a newer building or something that we think has got, a lot of longevity to it, we can take that amortization 25 years. But it all kind of depends on the deal. So a typical deal for us would look like I said, 5-year maturity, 20-year AM, somewhere around Wall Street Journal prime, somewhere between 0.5% to 1% origination fee, and then somewhere between 80 to 85% loan to cost. And so, it comes up sometimes where you get a good deal, where you get an under market deal, and you may be buying it for 100, and the appraisal comes back at 150, and then the investors wanted to look at, hey, let's go off that 150 value for the loan, but as a bank we really look at cost, and so the appraisal is kind of a weird thing in my world. Is it doesn't matter until it does. And so as long as the appraisal comes in over the cost, we're going to go look at what your cost was. Mm-hmm. But if the appraisal comes back lower than the cost, then we're going to look at the appraised value. So it's
lower of the two.
Right. Yeah. And so it's kind of interesting because I know we've had that conversation where you're saying, the investor gets punished for getting a good deal. Yeah. And I don't disagree. But we kind of look at it from our standpoint as we want you to have skin in the game. And so we're not going to lend you, 95% loan to cost, even though we're still in a good spot loan to value wise, just because we want you to be just invested in the property as we are.
Sure.
And so I know some people understand that and some people don't, but that's just kind of how it is.
Yeah. Is that the same thing on, if it's just like a cash out refi, if it appraises for, 150% more than what I've got into it, are you still looking at cost, or are you looking at that appraisal?
Well, it kind of depends. There's definitely a seasoning period. So, if you've owned a property for 5 years and you're looking at to do a cash out refi, then what you have in it doesn't really matter to us anymore because it's seasoned for 5 years.
Okay.
But if you buy a house and wait 6 months and just that you're trying to time the market, we call that manufactured equity. And so we probably wouldn't go off the appraised value. We'd probably look at what you have in it. But then again, every deal is different.
Yeah.
And so for something like that, if you've owned it for a while, we'd look at it totally differently.
Yeah. I guess that's the good and bad of commercial is the flexibility.
Right.
Right. Sometimes it works in your favor and sometimes it doesn't.
Right.
I like that. Okay. What about development? So this is more of a, selfish question, because I picked up a client this week who said, hey, I'm looking for some warehouse space, got an auto business. I'm going to be able to store cars inside, but I'm not opposed to just buying some land and building something.
Right.
What does the financing look like if we go buy some land and want to finance the purchase and the build?
Yeah. So then we would look at that from, again, a total cost standpoint. So, we've done these two different ways. So sometimes it's the person owns that land free and clear already, and they want to come in and build something on it. And if they own that free and clear, we take that as their equity in, because they already have, let's say, $200,000 in on the land. And so we're like, okay, well, that's your down payment. You've already got the equity in the deal.
Is it as long as that land represents at least 20% of the?
Yeah, right. Exactly. Yeah. Okay. And sometimes, we could go to 15% on that. It just kind of depends on the strength of the borrower and deposit relationship and all that kind of stuff. But if you're buying the land and building, all at once, we would probably do something along the lines of 80 to 85% of cost, and then do like a 12-month interest only for the construction. And then if your cost, let's just say, is $1 million, we'd make you put your 15 to 20% in up front. And so you'd be going in for $200,000 up front. And then we would fund the entire construction because your equity's already in it. And then any overruns, it can kind of get interesting. Depending on the size of the overrun, sometimes we can go back and get more approved, and sometimes we're already maxed out. The overruns are on you, and so like I said, each deal kind of is a little different. But the base for that would be we would fund the entire construction with your equity in up front.
Okay. Awesome. All right. So one of the big topics this year is what's going to happen with rates, right? No one has a crystal ball,
right?
So I'm not going to hold you to what you say, but where are you anticipating rates to go this year?
Yeah. So rates have gone up over the past, year or so, very quickly. I think when I first moved over to Riverbank, I think prime was in the 5s, and now it's at 8.5. And so, it's had this exponential rise, and we see it coming down, but not nearly as quick as it came up. So, and when they were bumping prime, they were bumping it at, 50 basis points or 75 basis points at a time. And we see it kind of going down a 0.25% at a time. So 25 basis points. So, if we're at 8.5 now, maybe by the end of the year, somewhere in the high 7s. Yeah. But we do see it coming down. And so I know we've had this conversation too, about, fixed versus float when we're doing a loan. And so I'm kind of pushing a lot of my clients to float right now, and take that interest rate risk, just because I don't want to get in a position where, we fix it at 8%, 50 basis points below prime. And then in 3 years, rates are in the low 7s, and they're coming back to me saying, well, hey, I want to refinance. It's like, well, I gave you the option when we closed the loan.
Yeah.
And so now, it's not going to be worth it for us to refinance this. Because, you took that interest rate risk on yourself to fix it rather than float it.
Yeah. If someone does that and decides to fix it, is there a prepayment penalty on that if they decide? Because if you say, well, it doesn't really make sense for us to refi it, but if they're like, well, I just go refi it somewhere else.
Right. We've started building in prepayment penalties, in a sense of, if you got a deal at 8 and then rates get down to 7 and you go take it to another bank and refi us out, then we'll charge some sort of penalty.
Okay.
But if rates go down drastically and it's a good loan for us, we could look at refine it on our books instead of losing the whole deal.
Yeah.
So again, it just kind of depends on each deal.
Yeah.
And some deals are, when they come to us and want to refinance, we're like, good, we
were hoping you would.
Right. And some we're like, no, let's try to work something out with us and not lose a good client.
Yeah. Break down the float a little bit more for me. So what all goes into that? What does that mean?
Yeah. So the floating rate means that anytime rates go up or down, that your rate will move with it. And so now that we're seeing that rates are probably at the top, and they're going to start coming down, we push people to float just because you can ride the rates when they start coming down. And so that's kind of a good idea for us now, because, you're taking interest rate risk and you're saying, okay, well, we see this coming down, so there's no reason to lock it in, when, the rates are going to come down and you're not stuck. And so that's kind of what we're looking at now, in a sense of, it's probably more advantageous to you to float, because it's when rates start coming down, you're going to ride that with it.
Yeah. And so I think the most recent deal we did, we decided to do that. And it's was it a 5-year?
5-year, yep.
Okay. And so it'll float with Wall Street. And do all banks always follow Wall Street Prime?
Yeah. So there's 2 indexes we look at. There's one that's called SOFR, and there's one that's Wall Street Journal Prime. And I would say about 95% of the loans I do are based off Wall Street Journal Prime.
Okay.
And so SOFR, we don't use it a whole lot. Sometimes it comes into play. And it more comes into play with some of the older school guys. That because they have been used to lending off that matrix for forever, and so they're more comfortable with that. But I guess banking has moved more toward Wall Street Journal Prime.
So the older school guys, you mean they work for the bank that are doing
both? Yeah, work for the bank or have been older businessmen who've been around for a long time.
Okay,
because that was it used to be called LIBOR. I don't know if you ever heard that, and then they transferred it to SOFR. And so it's kind of it moves more off the Treasury than Wall Street Journal Prime does.
Interesting. Okay. And y'all always just follow that, whatever it is.
Mm-hmm.
And then you just have points either added or subtracted based off the deal or whatever the situation is.
Yep.
Okay. That makes sense. Well, cool. So I'll switch up a little bit. So you've got a pretty cool project going on up here in Bluff Park. We've got, when we got that deal, we were trying to come on trying to make an offer right before it hit live. Ended up making an offer Did we do it sight unseen?
Yeah.
We didn't even go in it, right?
Yeah. So it was a house right up here on Park Avenue. We saw a coming soon sign in the yard.
Yeah.
And we really bought the location.
Yeah.
Because we knew the house was a mess. And that's why we didn't even go inside of it, because we knew it needed a lot of work. I think it ended up needing a lot more work than we anticipated. But it's been an exciting project. And so you had a very unique offer that you put in place for us that I think won us the deal. Is you came in there and got creative and said, hey, look, we're going to offer a little bit over, and it expires in 24 hours. And so put some pressure on the seller, and it ended up working out. So thank you for getting creative on that. And it was an awesome deal.
It's interesting when we do that, a lot of agents will get that. A lot of good agents will see an offer like that and just say, okay, thank you for the offer. We're just going to ignore the 24-hour part.
Right, right.
And just go on. But they didn't. And I knew the agent's great to work with who listed that house. And I think they did their research on you and Jade and who you were, and wanted to make sure that it wasn't just going to be flipped.
Right.
And it was someone that was going to, have a family and let us and enjoy it. And so I think, as much as I'd like to take credit for you getting that, I think it was, who y'all are and what your intention was with the property that won you the deal. So, so we got it. I remember we walked through for the first time, and you're like, okay, well, maybe we take this wall out, maybe we redo this over here. And then a week later, you're like, well, I think we're going to have to take a couple more things out, maybe extend out the back. Then a week later, you're like, well, no, we're going to have to take like the whole roof off. And then a week later, like the whole house was gone.
Yeah, right. Well, I will say, back up a little bit, you being in the investment flips and doing all that kind of stuff you didn't scare us away from it, because you're in that world and you could kind of see the vision that we were also looking at. So that really worked out for us, because you could have easily said, man, this is going to be a lot of work. I don't know if this is what you want to do, but you've done it before.
Yeah.
And so you kind of saw the same vision that my wife and I had. But getting into it, we realized it was going to take a lot of work, but I don't think we realized how much work it was going to be. I mean, once we started, pulling off drywall and getting into, everything that could have been wrong was wrong. And so we got to a point where we were going to spend just as much money trying to fix it up, rather than just bulldozing it and starting over. And so we ended up leaving, I want to say, about 75% of the foundation. But then the rest, we took it off and started over. So it's been a fun project, and I know I talked to you a little bit about this, but the city gave us a little hard time about it, because it is in a historic district, and the house was built, I think, in the 50s. So there were no variances or setbacks in the 50s. And so we had to go to the variance board and get approval for that, but it ended up all working out.
Yeah. And I think you told me you had to go around and get signatures from the neighbors.
And you helped me out a lot with that. Since you are Mr. Bluff Park, you knew a lot of the neighbors. And actually Reed King, another one of our Bluff Park United Methodist guys, helped me out with that. I think I ended up getting 30 signatures.
Wow.
And so, walking around the street, knocking on doors, sending out emails and texts, and everybody was happy to sign it. There was one guy that didn't like the idea that we had. But everybody can't like it.
Right.
So I just left his name off the list.
That's funny. The feedback I've gotten has been, all positive, right? Everyone's excited to see something new come to life right there.
Right.
And a lot of people, since you let me park my box truck, a lot of people think it's my project.
Yeah.
They say, what are you building on the corner? It's actually nothing. So, it's good. And our Jade's family's history runs deep in Bluff Park, and it's going to be good to have y'all up here.
Yeah, we're excited. We're
Jim.
Yeah, that's right. That's right.
So what's the update? So I think a week or two ago you said you're waiting on garage doors to get all the finishes in.
Yep. So we spray foamed this week, and so we're getting ready to do the blower door test.
Okay. Yeah.
What that is. This is a new term to me. Yep. So we should start drywall probably next week, and then from there it's going to move. So we're cabinets are ready to go in, hardwoods are ready once the sheetrock goes up. And so I talked to my builder yesterday, and we should be about 10 weeks away.
Oh wow!
So we're looking into April, early March to move in. Into April, early May.
Yeah. So you already have tile, faucets, countertop, all that picked out.
Yep.
So it's ready to go. Just need to get it in there.
Yep.
Man, that's exciting.
Yeah.
What I know you told me you've got, is it 3 garages and the last one's going to be a a gym with like the glass door on the back?
Yep. So we decided to do. It almost looks like a pull-through garage where there's a garage on both ends of the garage, or the third garage. And so the third garage is going to be a weight room, kind of model it after your weight room. And the back side of it will have a glass garage door that we can lift up and kind of make it an indoor-outdoor weight room. And so ended up, I wanted to do a pickleball court in the backyard. That was going to be phase 2.
Yeah.
But our septic system, the lines are running all over our backyard. So my builder was like, man, you got this big old backyard and can't do anything with it. But it all works out.
Yeah. Could you do one of those, like permeable court? I'm thinking of like the graded mats.
Mm-hmm.
You know what I'm talking about?
Yep.
It's kind of like the basketball courts that are like that water goes through.
Yeah.
I wonder if you could do one of those.
Yeah. It just kind of depends on what we're pouring on, or I guess below those mats.
Yeah.
Right. So I guess we could get creative and figure something out. I haven't thought too much about it.
Yeah.
Because I was all in on pouring some slab of it and painting it like a pickleball court. But I don't think it's going to work out that way. But yeah, because with the septic system, you have to have, or at least for us, you have to have 500 feet of field lines and then 500 feet of secondary.
Yeah.
And so that takes up all of our backyard. Yeah.
Unless you do an engineered, like a very expensive system.
Right. Sure. Yeah.
I've been going through that at the castle and spent tens of thousands of dollars on 2 septic systems.
Yeah.
And
so you get it.
Yeah. And it's actually funny, the secondary, kind of a side note, but we had to get like not a variance, but kind of like a addendum or whatever you want to call it from the health department, because our secondary area are where our wells are.
Yeah.
And so you can't obviously have septic field where you're pumping your water.
Right.
And that's the only area that was left.
Uh-huh.
So for a while, I was going through, should we cancel the wells and pump water from the lake?
Right.
Because we can't there's no city water we can tap into. There's a wait list for 2 years to get in the city water. And then I was like, so I went down a rabbit hole. It was going to be like $25,000 to like pump water from the lake, filter it, and do all that. And I was like gearing up to like, that's what we're going to have to do.
Yeah.
Or there was land for sale. There's like 25 acres across the street for sale. And so I actually reached out to the agent. I was like, could we buy like an acre?
Right.
And that'd be our secondary area right there. And we were going down that path as well, kind of chasing different ones at the same time. All while trying to get this petition to allow the health department to have the secondary area where our wells are, knowing that if we ever have to use it, then we've got to solve the water problem,
right?
Or buy the land across the street. So, anyways, I recently became very familiar with how that layout happened.
Right,
it's huge area.
Yeah,
I mean it's massive. And it's funny, very similar. We were going to have a pickleball court by the water, which was going to be awesome, like playing pickleball by the lake, and but because of where the septic field went, we can't. But we are doing it up in the secondary area.
Okay, yeah.
So we've got, actually that slab's being poured next week.
Okay, awesome. Yeah. So you're just doing just concrete slab and then going to paint it?
Yep.
Because we looked at, and I think you looked at it too, is doing it, the pressure treated stuff and doing it, like an actual tennis court material. But that was just so expensive. Yeah.
Yeah, there's tennis court paint that we're using. Sherwin-Williams has it. And actually, I found this out yesterday. They recommend not putting it on concrete until it's cured for 28 days.
Okay.
And we're doing, I haven't really announced this yet, but March 19th, we're doing a big open house out there. So I want you to come in.
Yeah.
But I'm like, we've got to pour this slab like in the next couple of days.
Yeah, right.
I got a 28-day period. So anyways, we're going towards that.
Yeah. That's awesome. That's gonna be exciting. So it's gonna be a huge plus on your listings.
Yeah. But it's dude, we bought that in March, so it's been almost a year.
Yeah.
So it's been a long project. So anyways, so enough about the castle. But so what are you excited about this year? What do you got going on personally, professionally?
Yeah, so personally, the biggest thing is the house. And getting in. We're fired up about it, ready to join the Bluff Park community. Hopefully, I'm not on the wait list again for the Wiffle Ball League. But that would be personally. And then, from a business standpoint, is continue the momentum we had in 2023. 2023 was a great year for us in the bank. And so just looking to continue that, make some new relationships, lend some money, get some more deposits in. That's the name of the game right now.
Is that what would be a win for you, is like volume of deposits and number of loans?
Right. Yeah.
Okay.
So we all have goals, and there's a deposit goal and a loan goal, and so to keep that momentum we had in 2023 would be awesome.
Okay. Awesome. Are you reading anything or listening to anything right now that you wish?
Not from a business standpoint, but my wife and I have gotten really into The Chosen. I don't know if you've seen anything about that. It's a TV show about Jesus and the disciples.
Okay.
And it's like kind of gives that real life perspective on it.
Yeah.
And so going back and reading the Bible and reading the Gospels, it's almost like watching the movie before you read the book.
Yeah.
So you kind of have the individuals in your head, and you can kind of visualize everything. So that's been really cool.
What's that on?
So the first season's on Netflix, and then I think season 2 and 3 are on Amazon Prime.
Okay.
So we've been getting after that. We kind of treat that as a little bit of church every night.
Yeah. Yeah.
So
that's awesome. Where can people find out more about you? You on socials, website?
Yeah.
Anything?
So I'm on. I have an Instagram, Facebook. It's all under Jack Hutcheson. And then on our Riverbank and Trust website, you can kind of learn more about the bank and who we are as people. I guess I'll give a little bit of background on Riverbank.
Yeah.
So we are 17 years old. We were started by our CEO now. His name is Jimmy Stubbs. He used to work at Colonial Bank and decided he wanted to start his own bank, and raised some money with friends and family, and ended up having enough to start Riverbank. And he wanted it. I think there was 3 branches when we started. So it started in the Prattville, Montgomery area.
Okay.
And so I guess the river region of Alabama, which is why it's called Riverbank. And then we've grown, man, to 22, 23 locations.
Wow.
We started, I think, with 25, 30 million in assets, and now we're at 3.2 billion in assets.
Holy cow.
In 17 years. So it's been an awesome growth.
Yeah.
We just came to Birmingham about 18 months ago. So we're now everywhere from Mobile up to Huntsville. We're all Alabama. So we're not on the west side of the state yet. So, and I think our next market would be Tuscaloosa. So we'll eventually be in Tuscaloosa. As of right now, we have no plans to get outside of the state, but obviously those things can change. So,
are there a lot of regulations when you leave the state?
I would assume so.
Yeah.
Because I guess there's each state has regulations and there's federal regulations. So I'm assuming that puts you in a different bucket, and it, kind of more red tape to get around.
Yeah.
Could be the play long term.
Yeah. Mm-hmm. Southeast region, and then do you think the idea is to build it and sell it, or keep it local?
Yeah,
I feel like banks change hands.
Right, exactly. I would think that we would scale up and maybe sell and highly maybe in the next 10 or 15 years. But as of right now, we've got no plans to change.
Cool.
And being the 3.2 billion assets, we're almost too big to just be bought by a big bank. There'd have to be some sort of merger. And so it kind of puts us in a nice spot.
Yeah. Yeah. You got some leverage.
That's right.
Well, y'all are great at what you do. Anyone out there looking for a commercial loan or get into the commercial space, give Jack a call, because I think you're great at it.
Awesome, man. I appreciate it.
Yeah. Thanks again for being here.
Yeah, absolutely.
Till next time.
I've enjoyed it.